Did you know that the longest bear market was about 13 years? At least that was how we perceived it as we lived through it. And what might you want to do with your T-bills, money market funds, and cash if you think a recession is coming? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So the beginning of this week was nuts, for lack of a better term. On just Monday alone, the Dow Jones Index, composed of 30 blue chip stocks, ended the day down 2.08%. The S&P 500 index was down 2.7%, and the tech-heavy NestEgg resumed its recent slide with a fall by exactly 4% for that day. This shocked many who had been expecting a smooth ride in the markets. And what happens when investors run scared? They go into bonds, and in particular, they flee into the safe haven of treasuries. So yes, Monday also saw treasury prices being pushed up and treasury yields pushed down. That's the inverse relationship between bond prices and yields. Now, markets go up and down all the time. They always have and they always will. That's just the nature of markets. What's been different in recent weeks is this: recession fears. In fact, it seems that every passing week sees more and more talk on Wall Street about the possibility of an oncoming recession, and more headlines like this one. Wall Street ends sharply lower as recession fears loom. And we see these recession fears in the questions that you send our way, because more and more of those questions also have to do with recessions and your money. So with that in mind, here are the 3 topics that we'll be covering in today's video. 1. What was the longest bear market in recent history? 2. What's happening with this weekend's potential government shutdown? And 3. What might you want to do with your T-bills, money market funds, and cash if you think a recession is coming? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What was the longest bear market in recent history? So, a bear market is defined as a prolonged period when investments fall 20% or more from their last market high. We've had 12 bear markets since 1956, where the S&P 500 declined at least 20%. This equates to 1 bear market starting nearly every 5.5 years. This column shows when the bear market started, the month and year. This column shows the percentage decline from peak to trough, from the highest point to the lowest point when prices bottomed out. And this column shows the number of months it took to get from peak to trough. This column shows the number of months it took from trough to full recovery, from the lowest point back to the previous peak value before prices started collapsing. And this column shows the number of months it took from previous peak to full recovery, or the number of months it took to go from peak to peak, as we say in the industry. This column shows whether the bear market was accompanied by a recession. And this row shows the averages for these 12 bear markets. The average bear market saw a decline of 33% and lasted about 13 months from peak to trough. But it took on average almost exactly 3 years after prices started falling before the S&P 500 reached its previous high again. After the year 2000 internet bubble, bear market, and recession, it took 87 months, or more than 7 years, for full recovery back to the previous peak. And after the year 2007, banking or great financial crisis, bear market, and recession, it took 67 months, or a bit more than 5.5 years, before the market reached its previous high again. In fact, the 2 bear markets of 2000 and 2007 almost merged into each other. Here's the peak in 2000, right before the internet bubble bear market hit. Here in 2007 is when we reached that peak again. And almost immediately afterwards, the S&P started falling again in the 2007 banking or great financial crisis. The overall effect, it was only in 2013, after almost exactly 13 years, that the S&P 500 finally exceeded its internet bubble peak from 2000 in a sustainable way. Those of us who invested in the S&P 500 during that period may remember it was not a good period overall. And 13 can indeed feel like an unlucky number if it takes that many years before the stock market reaches its previous peak again for good. Bond Masters course, folks. Please refer back to Module 7 in the course, Video B on bear markets and recessions, for anything that we've covered in this section of today's video, as well as the rest of these videos here on what you can do in bad or bear markets and some key strategies to consider during the decumulation stage of your financial journey. Now, this is not to say that we're headed towards a recession or, worst case, a longer-lasting multi-year bear market. But given the stock market and interest rate highs we've seen over the past few years, I think it's really important to be reminded that stock markets and interest rates don't always just go up. And all the economic uncertainty that exists currently and President Trump's less than reassuring words aren't really helping much either in this instance. As Fox Business reports from an interview they conducted with him, Trump says the U.S. will experience a period of transition when asked if the economy could see a recession this year. Now, Commerce Secretary Howard Lutnick tried to calm the waves down a bit by saying there's no chance of an economic decline. But even on this screenshot, this is so small, it's practically a footnote. So I'm not surprised that Lutnick's statement was not repeated as often as President Trump's here. It also doesn't help with the mood in the markets that the Federal Reserve Bank of Atlanta recently adjusted significantly downwards the best estimate for how the real GDP of the U.S. economy might develop. The Fed GDP Now estimate, as it's called, previously showed reassuringly stable expectations for a growth rate of slightly above 2% for the first quarter of this year. But here's where it stands as of March 6th, at minus 2.4%. And yes, on the chart, it can look a bit like our economy is about to go over the edge of a cliff. As I always say, no one has a working crystal ball, not even the Trump administration and the Atlanta Fed. But there has clearly been a shift from a soft landing scenario to a recessionary one in recent weeks. And the possibility of an imminent government shutdown this weekend does not help to make things any better either, which brings us to the next section of today's video. What's happening with this weekend's potential government shutdown? As our Diamond NestEgg regulars know, our country is not just bumping up against the debt ceiling yet again. We also haven't had a proper budget agreed and signed into law for quite a few years now. And yes, 2025 is not different. And while the House has passed a proposal for a budget for this fiscal year, it seems it may not be approved by Congress and signed into law anytime soon. So, what all administrations, both the previous ones as well as the current administration, have been doing to keep the government going under such circumstances is to enact a so-called Continuing Spending Resolution, or CSR. A CSR essentially allows the government to continue spending at current levels for a specified period of time. Now, the current CSR is due to expire this Friday, March 14th. And yes, this means that we might see one of our, by now, almost regular government shutdowns starting as soon as this weekend, unless Congress passes a new CSR or someone comes up with another resolution. That said, and speaking from a longer-term perspective, I'm not so pessimistic about a potential government shutdown for 3 reasons. Reason 1, as Bloomberg reports, this time neither party has shown an appetite for a shutdown. As I'm taping this, the House just took the first step and sent a new CSR to the Senate that would fund the government until the end of September and buy some time to work on the proper budget. That said, the Senate needs to agree and could still filibuster the CSR. All fingers crossed here. Reason 2, we've all been through a few shutdowns in President Trump's first term, and it appears that while not painless, the country seemed to cope relatively well and recover quite quickly. This Barron's article sums it up nicely. A government shutdown could create short-term volatility, but it's mostly noise. So hopefully no persistent damage here, even if it were to happen again. And yes, even the furloughed federal employees have so far always gotten their full back pay once the shutdown was resolved. And reason 3, Key functions of the government are expected to continue to perform without interruption, as essential federal workers will not be sent on any furlough. This includes debt service on our treasuries, both for principal and interest, as well as Social Security payments, Medicare, and other entitlement programs that are written in the law. This was also the case in previous shutdowns. If you want more details on what happens during a government shutdown, I've linked this video in the first pinned comment below for your convenience. Like I said, we've been here a few times before, so this is nothing new, and we do have a bit of a historical precedence on how things should play out. Now, this is not to say that there will not be some short-term pain. After all, an imminent government shutdown is not going to encourage federal employees or anyone else to go out and spend money. Quite the opposite, in fact. Plus, we're still going back and forth on tariffs, taxes, and DOGE. And those are just the financial areas that President Trump and his administration are battling right now. I could keep going. The reality is that cost cutting, reducing spending, and the change that comes with it will, under almost any scenario, always be painful for someone. It can be painful when it happens in our own personal lives, and it's even more painful when it's our federal government, which touches on the lives of every single American, and even many outside our own country. So, as always in life, in turbulent times, we should hope for the best case scenario, but be prepared for the worst case scenario, which brings us to the question that many of you have asked us recently. What might you want to do with your T-bills, money market funds, and cash if you think a recession is coming? As a reminder, a recession in economic terms requires 2 consecutive months of negative GDP growth to meet the official definition. We're not there yet, and I really hope we won't get there for quite some time. But for the savers in our community who like to plan a bit, here's my thinking. First, if you've been considering going long on bonds and you have a strong opinion that a recession is near, your best bet may be to start moving some of your T-bills, money market funds, and cash into longer dated bonds to lock in the current rates before they come down. This might especially be something to consider if you're already in retirement and have no appetite to wait out a potential downturn in interest rates. And if you've already been dollar cost averaging into longer dated bonds, you may want to increase the amounts you've been buying, because the classic way to combat a recession is to lower interest rates as a means of encouraging economic growth, meaning that the current yield on T-bills, money market funds, and cash will likely go down. Plus, while the Fed typically only controls short-term rates, long-term rates have historically tended to follow a similar downward path when there is fear of a recession. This means that all else being equal, longer dated bond yields would also likely come down. Second, if you're more focused on equities, then you may want to continue hanging onto your cash and T-bills initially. This way, you can continue earning the current yields for as long as they last and still have enough dry powder or liquidity to pick up some low-cost equities whenever the market hits a patch that looks like a buying opportunity for you. From what I've heard, that's what some of you actually did this past Monday. And third, you can also do nothing, meaning you stick with your plan and continue doing what you've been doing. This is the bucket that we mostly fall into. I've moved a bit of our excess emergency savings around, mostly from money market funds to T-bill ladders, as I talked about in this recent video on money market funds at Fidelity, Schwab, and Vanguard. But other than that, we haven't changed much. We have a fairly long time horizon, think 20 plus years, assuming we live at least that long. So our savings and investment strategy is fairly simple and straightforward. On the very short end, we have a bit more than 1 month of emergency savings in our bank, which pays basically nothing, but we don't really care in this case. On the very long end, we dollar cost average into equities in our retirement accounts. And for everything else between the two, what I refer to as in-between money, because I'm creative that way, our in-between money is mostly in T-bill ladders and Vanguard's VMFXX and VUSXX. So, as always, at this point, curious minds want to know, what are your thoughts about an economic downturn or recession? Are we headed towards one? And how shallow or deep will it be? And if you're preparing for a recession, where are you keeping your money? And what are your plans for going forward? drop a comment below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about treasuries and bond investing, then check out this video here on our bond courses. And as a reminder, our next Bond Masters live online course session is this Sunday, March 16th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into next week's 20-year T-bond and 10-year TIPS auctions. And our next live member Q&A is on Sunday, March 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time, where we will be talking about this month's 2-, 5-, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.